Treasury yields nudged higher after a very volatile week last when we had, not only do we have a Fed meeting, we had UK elections, we had an ECB meeting with Ms. Lagarde sitting at the head of the table for the first time. And oh yeah, we had that whole trade phase one thing likely going through. And at this point over the weekend, none of that momentum has seized. We have yields are higher, only modestly higher, still within the range. If you include 190 to 170, I know we moved higher than 190 recently. You want to widen that out to 165 to 195. But at this point, the range is still, the market remains inside of that range. And we aren't seeing any spike knee-jerk moves higher in yield or lower. At this point, I would have thought we would have seen a breakout move after last week's event had passed. Given the fact that the Fed had a rosier than normal outlook, given the fact that we got the trade deal done, I still think there are some cautious holders of bonds that aren't buying into this yet, or at least not until we get through maybe first quarter of next year, when we get through any of this economic risk that we've sort of been overlooking given the whole China trade and central bankathon that we saw last week. Market volatility got crushed. It got crushed towards the end of last week, and it got crushed even more today. Obviously, there's no fear of the market making a knee-jerk reaction outside of that range, and with equities making all new time highs, and with optimism sort of on the rise again, there is no need to see any major buying of rates. It's kind of a risk-on trade, and a risk-on trade means get out of riskless assets and into risk assets. But I think at this point, as I previously said, that we're not actually seeing huge sellers of bonds. You're seeing modest movement, I think, from allocations out of bonds and into stocks, but not in any great size. So at this point, equities will continue higher. Bonds are probably going to still hold that range, at least until we get through year end. And lastly, we did get one announcement today from the New York Fed. They talked about their business optimism. It's at a 5-month high, and that's for a 6-month outlook. And I think that's pretty significant, because not too long ago, we were concerned about recessions coming at the beginning of 2020. If the New York Fed's telling us that their business outlook is at optimism is at a 6-month high or a 5-month high going out to the middle of next year, that's got to be something that they got to take into account. Obviously, that means the Fed is probably not going to be cutting rates, or possibly even talking about raising rates, and that would be very bearish to bonds. But right now we aren't seeing that. With just a slow and steady push higher in yields. I think at this point we have year-end kind of hovering out there, looming, and that will keep any big knee-jerk reaction from occurring. But keep your eye on the stock market. That's sort of the pulse of what's going on in the macro markets. But the bond markets, it's not buying into it full yet. Probably have to wait until we get through at least some of first quarter, get through the year, get through year end, get through some of first quarter before we see a major move in bonds. And of course, that's going to come with anything from the Fed, any continuation from China and the U.S. trade, and again, the economy, which is not something we've been focusing on, because last I checked, we have a presidential election coming up in 2020, and that is going to become a lot of the talking points. How's the economy doing? Where's it going? What are the risks? And that's where we're going to get back to the basics and watch the economy, watch where it's going, watch where it could be going. And with that, I think right now we're going to continue to see slow and steady yields trade that range, that 165 to 195 or 170 to 190, whichever you prefer, as we go into year end, unless something dramatic happens which would push yields lower. At that case, you could see a big move down, but at this point, it's not on the radar.